This is the current federal tax developments for the week of April 9th, 2018. Current federal tax developments are brought to you by Kaplan Professional Education and your state society of CPAs. I'm Ed Zollers, broadcasting this week from Phoenix, and going to be a little different this week because it's late in tax season and I'm having juggling, of course, all the end of tax season stuff. So we don't have the written document, shall we say, we usually put together that we have with a bunch of stories to back up this week's developments. We are going to talk about developments because there are a number of them going on. And interestingly enough, this week, our big issue is going to come up that a lot of states are doing things right now because state legislatures often meet early in the year, or they have to adopt their budgets for a June fiscal year, June fiscal year end. So they have a July fiscal year coming up. So we see a lot of state activities, and this year in particular, we're seeing state activities that have a federal bent of some sort. That is either a constitutional issue, which we'll discuss here in just a second, or dealing with some issues that came up due to the Tax Cuts and Jobs Act, specifically trying to get around the state and local tax deduction limitation. But let's start with something coming up here. It's coming up actually on the 17th of April. The U.S. Supreme Court is going to hear the arguments in the case of the state of South Dakota versus Wayfair. Now, you may remember we've discussed this before. South Dakota adopted a law that effectively is going to require people with no physical presence in the state of South Dakota who merely sell enough into South Dakota to collect and pay over the sales tax. This particular case was designed specifically to challenge the Quill case, the old North Dakota Quill case that set the standard we have now that said, hey, there needs to be a physical presence in the state for the state to be able to force a seller to collect the sales tax. Since then, we've had a lot of changes. We've had, obviously, the rise of internet online sales, and the states now are complaining that this world is very different and they are losing lots of revenue. And they want to be able to overturn Quill and be able to collect sales tax from anyone selling into the state, or at least anyone selling above certain levels. And we'll talk about those levels here in a second with some developments we've had in various states over the past few weeks. But this particular case is going to be heard, and if this case goes in favor of South Dakota, many are concerned that, especially if South Dakota wins hands down, they simply say there's Quill's gone, nothing to replace it. If you sell into a state, the state has a right to force you to collect sales tax, period. We're done. Let's all go home. If that happens, there's a lot of concern about what's going to happen in terms of entities having to report to these multiple states, and potentially, since if this was always true, constitutionally we weren't prohibited from, the states weren't from collecting these taxes, are companies going to owe back taxes to various states. Now, the states have told us, no, we don't plan to do this, but all it takes is one of them to do it, and it could be a real nightmare for your client. Many organizations have submitted friend of the court briefs in this case on both sides. Not surprisingly, a whole bunch of states have submitted briefs in the case, arguing that, the Quill case should be overturned in favor of South Dakota's position, stating that, the states need the ability to tax a sales tax. Some other parties have filed briefs with the court on the other side of that, stating that, especially business groups have argued that we shouldn't be changing this, right? We should keep it the same, especially business groups that represent online or mail order sellers. One interesting aside, though, is the United States Solicitor General submitted a brief in favor of South Dakota. And that's a little bit surprising. You may have been aware that Congress had some consideration in the final Budget Act of potentially touching this. There was a push made especially by a representative from North Dakota, to have a bill passed by Congress to deal with this ahead of this case, so that there'd be some standards in place before the Supreme Court ruled. She argued to eliminate the confusion. Well, Congress didn't do that. A lot of it because a lot of members of Congress feel that this would be interpreted as a tax increase, and they really don't want to be voting for that. But the administration has taken a fairly shall we say, clear position in favor of this, and the Solicitor General is in fact going to have time to speak in favor of South Dakota's position on the court. Now, they are going to talk about maybe limiting this. The Solicitor General's position said, well, this should probably be limited to online sales. Traditional catalog sellers should still be able to use Quill. So we'll see if they get that nuance. The real question we've got is where they go. A number of other groups have thrown in favor of Wayfair. We talk about business groups, but also you might be surprised. Say, wait, the state of Montana. Well, it won't surprise you at all when you realize there's one thing the state of Montana doesn't have. That's a sales tax. And so the states without a sales tax are the few states that are throwing in on the side of Wayfair, because there it's just going to be a negative impact on businesses in their state who have to comply with these filings in other states. As I mentioned, it is really not clear if South Dakota wins how this is all going to play out. Will it force Congress to act? Will we have a free-for-all? Will the Supreme Court outline some limitations on what states can do? None of that's very clear right now, but this is a major case. We expect it to come down this summer. But that has not stopped states from doing things. First, we've kind of discussed this before. The state of Idaho, in their case, in the Idaho House Bill 578 that came out in March, they expanded their sales tax effectively to any business that sells more than $10,000 into the state if they have an agreement with a business that has nexus in Idaho to basically sell for them or refer customers, like affiliate agreements, right? Things like that. It hosts a website in Idaho that refers to your product, and you sell into Idaho, then the theory is you need to collect and pay the sales tax. This is unique because this is very similar to South Dakota, except they have what I will refer to as a Wayfair clause in this bill. This particular bill says that you can defend yourself if you're outside the state of Idaho, and you claim, well, this bill shouldn't apply. This shouldn't apply to me, as long as you can show that you don't have nexus under the test for the U.S. Constitution. Obviously, what they wrote that in there for was whatever the Supreme Court does in Wayfair, that's going to define the scope of Idaho's ability to go after you if you sell more than $10,000 into the state of Idaho and you have any sort of relationship with anybody in Idaho that relates to selling this product. So interesting deal. Now, the other key thing to note about them is they use the $10,000 limit. That's much lower than the economic nexus limits we've seen from states initially when an economic nexus theory, and by the way, almost no state except now South Dakota and at this point indirectly Idaho has tried to argue for a pure economic nexus. That is, merely selling in the state gets you there. Usually they've paired it with some other theory like Massachusetts cookie nexus, right? Saying, well, yeah, you really do have a physical presence because you load a cookie on a machine in Massachusetts. Okay, that seems like a stretch for physical presence, but they argue you have it. What we're seeing, though, is now we're going to see a physical, we're going to see straight economic nexus, but that had been at levels that started years ago at like 500,000 or 200,000 in sales into the state. Now Washington went to 10 grand. Idaho has also gone to 10 grand. And we're going to discover that that's not the last one. We're going to find more here. The standard non-filer late filing penalties would apply in this case because you're supposed to collect the tax. What's happened in a couple of other states recently is 2 states have adopted Tattletale laws. Okay, this is House Bill number 61, which was passed by the Georgia legislature. It is still awaiting the governor's signature in Georgia. But what this bill would provide is a Colorado-style law for Georgia. You may remember we discussed the Colorado law when we discussed the cases, that came down with Colorado's Tattletale law. The Tattletale laws work very simply. If you decide either if you're not going to collect sales tax for the state, which is fine, you're allowed not to. They're going to say if we can't force you to, we're going to accept maybe per quill we can't force you to. But what we can do, and this is what the 10th Circuit said was fine, and the Supreme Court did not review this decision, we can force you, though, to to basically tell the people who live in our state that are buying from you that they have a use tax liability, they need to report that use tax to the state, and that you are going to turn them into the state. At the end of the year, you send them a list of what they bought. And again, remind them they have a use tax liability to the state, and they're going to turn them in. And that document usually needs to be in their hands by the end of January. And then, as I said, you're going to file a statement with the state that tells them all the people in their state that bought from you, what they bought, and how much they paid, so the state can then go down and go after them for use tax. So this is a Colorado-style bill that's been adopted in Georgia. Georgia's trigger is if you have more than 200 transactions or $250,000 of sales into the state of Georgia, more than 250, you have to file this. You have to basically either collect the sales tax, which you can do that, or you can go ahead and turn it, do the Tattletale rules, put these notices on your website, put these notices, in the invoice when you bill the customer, send those mailers out the end of the year and send the report to the state. And this is it. So anybody who has more than 500 in purchases would be reported in this case. So there is a secondary here. If somebody just buys something from you for 20 bucks, nope, you won't have to report them. You won't have to give them their statement. But if anybody spends 500 bucks, they're in your list. Now, this particular bill takes effect January 1st, 2019. So you have a little time to plan. Not a whole lot, but a little. Again, this is it. Now, Georgia's penalties here are 20%, are essentially not, I should say 20%. I'm coming to Oklahoma too quickly. Their penalties are based on a per report you didn't file. So it's like 5 something per report you don't file. That's a little more traditional penalty structure, which is an information return penalty. It's not like what Washington did, which has a very draconian penalty. Again, $10,000 limit, a tattletale law, and a very draconian penalty that adds up very, very quickly. And it's in the 5 figures as a minimum penalty. In fact, as I recall, the Washington rule, if you went through the math, go through that program we did a while back, it's like a $45,000 minimum penalty for not complying with Washington's law. So yeah, this one's not as bad as that. Another state came in, Oklahoma this week, did the same thing, passed Oklahoma Bill number 1019. This was basically passed on the 6th of April. And what it does, it overwhelmingly passed both houses of the Oklahoma legislature. I mean, there were less than, single digits who were against the bill. As I recall, in one house, there were 2. In the other house, there were 7 against the bill. So overwhelmingly, it appears very bipartisan, shall we say, approach. In this case, everybody's voting for it. So everybody's in favor of this bill. Now, the trigger for Oklahoma is just like Washington, $10,000 into sales in Oklahoma. It is based on a July 1st to June 30 year. So it starts in effect July 1st of 18. So you go back and you look to July 1st of 17 to June 30 of 18. Did you sell more than 10 grand? If you did, then this law applies to you. Okay. It also applies to remote sellers, marketplace facilitators. That's things like, Amazon Marketplace or eBay, and to refers. This is also interesting. If you have, use one of those refer codes. So you tell somebody, you list on your website, here's some of the neat things, that we recommend you might want to buy. Maybe list some things on there. Say, I recommend you buy these books because I think, let's say these books have something to do with the tax law. Maybe we're publishing a brand new book on the tax law. So I say, hey, this guy's publishing a brand new book on the Tax Cuts and Jobs Act. I really think it'd be useful for you. I put a link on my website for which I'm paid a commission. That makes me a referrer. If you get over the limits, all of those have to do some reporting. Referrers actually end up having to tell the parties they're referred to, that they referred sales to, that they may have this problem in Oklahoma. The marketplaces similarly have collection and reference issues, and remote sellers have these issues. Now, the bill's called the Amazon bill, which I find a little amusing because if the trigger was higher than 10 grand, I would say, yeah, it's going to catch only the big fish like the Amazons, and the eBays are going to have to comply with this bill. But at 10 grand, it's going to catch a lot of really, really, really small fish are going to be caught in this net if you're selling into the state of Oklahoma. Okay. Now, you can elect to either collect the tax or make notice requirements. And technically you file this election every year in June. You tell us which way you're going to go. If you don't file an election, you're deemed to make the election to make notice, but you always can switch to collection. You can also come in and tell them you're going to do the collection. I mean, it's kind of a weird election scheme, but you can change. What effectively means apparently is you can decide, I've been collecting, I want to go to notice, but I can't go to notice till July 1st of the next year. But I could go to collecting at any time. The penalty is a maximum of $20,000 or 20% of sales. So whichever one is essentially less. We cap at a maximum of 20, but if let's say you only sold 10,000 into the state, then the penalty would be $2,000. So basically the penalty for not complying with this law is going to run from $2,000 to $20,000. That'll be your penalty. So that's not as bad as, the Washington problem, but it's not nearly as, as easy to deal with as the Georgia problem. These are not going to be the last states to do this. What we're finding very quickly is that Justice Gorsuch, he was one of the panel members that heard the case of the challenge to the Colorado statute that the 10th Circuit heard. And in his concurring opinion, he made a statement, which now is apparently the states are trying to prove true, that he said, if we are correct, and apparently we're going to assume they are correct, that the states can do this, then every state should, we can expect that most, if not every state with a state sales tax will adopt a similar law. Well, we're seeing these, they're piling up now. The key thing to remember about these laws, these Tattletale laws, is that no matter what the Supreme Court does in the case of, we talk about the Wayfair case, they're not going to affect these laws unless they really go out wild and come up with some, much broader expanse than Quill. And again, they didn't take the initial case, the Direct Marketing Association versus Broll case out of Colorado. They turned down the right to hear that. So we're going to assume they're probably not going to overturn that. Certainly there appears to be at least one judge on the court who's unlikely to overturn that. And so it seems very likely that these Tattletale laws will go. So if Wayfair wins in the case, so they decide they're not going to change the Quill precedent, don't be surprised if you see a whole bunch of states then come in with these Tattletale bills. Now, that said, most people seem not to be leaning on the betting that at some form, at least, Quill's going to be substantially weakened, if not overturned. Why? Well, I heard a line said once, it's always good to kind of bet with the appellate. Whoever is appealing the case, if the Supreme Court hears the case, you want to go that way, because if in fact nobody on the court agrees with South Dakota's position, then there was no point to hear the case. Just let the South Dakota Supreme Court's decision stand. They didn't do that. So now, having decided to hear the case, a lot of people think that, yeah, we're going to see Quill either substantially weakened or just flat out overturned entirely. Well, let's get off the sales tax for a second. Let's talk about another issue here from the states. The state of New York adopted the state and local tax limitation workaround provisions. This is part of the New York budget bill. And of course, it's a really big bill, has lots of things in it, but it has these provisions. It was passed by the New York legislature on April the 3rd. They adopted two separate methods to attempt to offset and get around the $10,000 limit on the state and local tax deductions. I was actually recording an update on the Tax Cuts and Jobs Act in Westchester County, New York, at end of last year when all of this was going on, and people were rushing to pay taxes, and that's a whole different discussion, not part of this, as to whether you could prepay. But an interesting stat that I found out there that they were mentioning is the average property tax bill in Westchester County is just over $10,000. That means even before income taxes, property taxes are going to take people over $10,000 a whole lot of the time in Westchester County. And that'll be true in other areas, especially areas near the New York City region. So we'll see a lot of that going on. So New York had an interest in trying to work around this. A lot of people in New York, who are paying these tax levels, are seeing this big loss of deduction, and it has a negative impact. I've seen examples of people in the New York area who are paying a lot of income tax to the state of New York that are going to take a hit and are going to pay extra tax under federal law going forward. Now, they've got two different workarounds, and they're kind of interesting. The first workaround is a tax credit for 85% of donations to one of two funds. One fund is going to assist in funding education, and one fund is going to assist in funding healthcare. Obviously, two big things the state, runs and pays for. And the idea being, I make a $10,000 deduction to the fund to assist in education, and I would then get an $8,500 reduction in my New York State income taxes. So let's say my New York State income taxes were going to be 20 grand. Otherwise, if I gave 10 grand to this fund, I would get an $8,500 reduction. So I'd pay only $1,500 extra. And the theory is that $8,500 then, the federal income tax deduction on the $8,500 is going to be worth more to me as long as I'm in a higher bracket than the $1,500 cost that I'm paying the state of New York. So because of that, I will work around. The bill also allows localities to set up similar programs to offset property taxes with the same sort of, contribution deduction. So interesting type of thing. Now, these are based on, let's be honest, we've had a lot of states adopt provisions where if you put money into some fund, for instance, Arizona has a whole bunch of these. You can put money into a fund for public school activity funds, and you get a dollar for dollar reduction in Arizona tax. You can pay into a private school tuition organization, and you get a dollar for dollar reduction. In fact, I've heard a couple of people make the claim that in Arizona, paying state income taxes is voluntary in the sense that you can just get rid of your state income taxes by paying all of these charitable contributions. And of course, I've actually heard a few people now start discussing if they're over 10 grand in Arizona, making sure they pay these charitable contributions next year to be able to continue to get a deduction. Well, New York is using that now, same basis. There is a chief counsel advice from 2011 that found the structure I mentioned here that Arizona and some other states were using was okay. New York is betting on that. We'll talk about whether that's going to work or not, but obviously, New York is betting on getting around it. The other way to get around it is they're going to adopt a payroll tax. It's an optional payroll tax. Employers can opt into it. Now, you might think, why in the world would an employer opt into a payroll tax? Well, this tax only applies on wages in excess of $40,000, and if the employer pays this payroll tax, presumably deductible to the employer, then the employee will get a credit on their New York State income tax return for that payroll tax. So conceptually, it would work like this. If I'm your employer, I will reduce your tax. And of course, you've got to do the equation to get this to work out perfectly. But I'm going to reduce your tax at a point so that the payroll tax I'm paying is essentially equal to the reduction we just made in your wages. And therefore, you can then you'll take that as a credit against New York State income taxes. The employer gets a deduction for the full amount of what they're paying you, just like before. So before they were paying you 100 grand, now they're going to pay you, less than 100 grand. Get the 5%. And I should have worked the math up before I started this. It won't be 95,000 because it's going to be in excess of 40. And then remember, the mere fact that that's not there is going to lower the tax. So, they'll pay you somewhat less than that. But then the employer will get a deduction for both of those. So they'll still get the deduction for 100 grand. You won't get 100 grand in your paycheck. But what's going to happen is you can reduce your New York withholding because you're going to get a direct offset in New York income tax. And by the way, because that's not income to you, you never receive the wages. That means your federal taxes are not even do you get the deduction, but you get it effectively above the line. Now, the problem with that is the mechanics of doing that is messy as heck, especially if you have a multiple state employer, you have, you set wages, you set earnings for people at kind of equivalent levels. This is going to be messy as heck to make work. But, the theory is that's how we'll run it. It seems very likely one or both of these will be challenged by the IRS. Now, of course, in the first case, the tax credit, the IRS's challenge right now is to differentiate this between what there's offered in states like Arizona. And the issue here is the obvious attack is you're getting something of equivalent value for the contributions. That's not really a contribution, which is great, except that old chief counsel advice says that, we don't count state income tax reductions as a benefit. And they kind of expanded the logic from, well, we don't worry about the fact you get a income tax deduction, when you make a contribution to a charity. We've never worried about that. Well, credits are the same thing, even dollar for dollar ones. So we're just going to ignore them. Obviously, if you apply that theory, we have a little problem here. The CCA does have one sentence that says, well, there might be a case where maybe we would have to reduce it, but it gives us no clue what that case would be. And in fact, then goes on and says, but generally it's never going to happen. Don't worry about it. A chief counsel advice is not binding. There is a revenue ruling that goes back into, as I recall, the 70s or 60s. I think it goes back to the 60s even, that made it very clear that, if you, let's say, agreed in this case was to improve, you paid for restoration of a house for the city because the city couldn't afford to restore this historic building. But in exchange, you were allowed to use the building rent-free for 15 years. All during that time, you would do all the maintenance, and you would, if there's any damage, you would bring it right back up to the standard that you had brought it to initially. And the IRS ruled, well, in that case, we've got to assume that you're getting an equivalent benefit. Because you're getting that equivalent benefit from the state, we're not going to consider that a charitable contribution from the city. I should say, you're not getting a charitable contribution to the city. That ruling would appear to be very good, except that old CCA gets in the way. And the problem is, of course, if you take out that old CCA, then there's a whole bunch of credits that people are taking now, relying on that chief counsel advice that would potentially be at risk. So could be interesting to see how this plays out. The payroll tax one, I think the big problem there is just simply mechanically, it's a pain to do. The Tax Foundation, who's no friend of these structures, has kind of indicated that they think it works, but it's a mechanical mess. And it's clearly a mechanical mess to try to get this done. Nevertheless, expect to see other states now, high tax states, adopt similar rules. And one of the problems you're going to have is you're going to have to decide this year, when you have a client who participates in a program like this, is that position sustainable on the return, or should there be disclosures on the return? What exactly and how are you going to do it? Finally, I want to tell people, just give you a heads up, that the IRS was busy the first day of last week. They issued a number of pieces of guidance. Notice 2018-26, they issued a 43-page document that had specific rules about the Form 965 tax that we have here as we go from converting over to the new system. That's that payment that's going to be due on April 17th for individuals and for corporations. And 43 pages tell us how to deal with this. It does duplicate some of the stuff that's in the frequently asked questions we mentioned before, but it also has some other information. For instance, it has a waiver of estimated tax penalties for this tax. We didn't know it was there. It seems to make sense. The AICPA has sent a letter to the IRS asking for additional relief. Specifically, the AICPA says, look, if I've got a client here who, let's say, is overpaid by $10,000 on their individual return, and it determines they have a $10,000 965 payment. Well, penalty is the way they'd view it, but it's just a straight payment. Literally reading the frequently asked questions, they still got to send a $10,000 check in when they go for their extension. So the AICPA is hoping that's not going to happen. Hoping we can offset those two. They also talk about what happens if we get the number wrong on the extension. Are we going to just allow people to modify that and use the modified number? We had two other things released. Notice 2018-28. That has information on the business interest deduction limitation. If you have a large business, right, over 25 million in revenue, remember, we have limitations on deductions of interest. If you have that issue, you want to go take a look at this notice. The one nice thing in this notice we did find out is, as we were hoping, you can take a consolidated group is allowed to get the whole group together. Now, if you just have an affiliated group, you have an affiliate that's not part of the consolidated group, that affiliate stands on its own. But in this case, a consolidated group can net things out. So you could have one highly leveraged subsidiary, and you could use the income from a non-highly leveraged subsidiary to allow you to claim the deduction. Also, notice 2018-29, the IRS gives some guidance on withholding on sale of foreign partnership interests by foreign partners. And I think some people thought this is unfortunate. They have kind of said for PTPs, ignore it for a while, we'll get some guidance out. But for small partnerships, no, they're not going to waive it. In essence, they're telling you they want you to start collecting now. So if you have a non-publicly traded partnership, that you have a foreign partner being bought out, you're going to have to follow the withholding rules. Now, you did 3 things in one afternoon on Monday. You thought, well, hey, that means the guidance is coming out. We'll have more. Nah, they kind of stopped after they got the notice out on the withholding of partnership interest. They were done and didn't issue anything more. So we'll see if more comes out. Hopefully, we'll take a deeper dive on this once we finish tax season. And I want to remind you that, yes, I've got scheduled courses coming up in May. We're going to talk about a lot of the issues with the Tax Cuts and Jobs Act, courses on the Tax Cuts and Jobs Act, or I've got courses on the qualified business income and the business-related issues. Those are all coming up in May. So, hey, shortly after tax season, keep your eyes open. I'll be in a few states doing those, so keep your eyes open for those courses. Well, as we say, it's coming up the end of tax season. Be sure to watch for courses coming from your state society. And I should remind you of one other thing. We here at Kaplan Professional Education, we go ahead and we will do in-firm courses too. And we do them, we'll work with your state society to help you book us in there. If you have some courses you want run, you want some topics, we do talk about that, so we can talk about what we can do. Remember, Kaplan Professional Accounting Education does not only tax, because this is the tax discussion orientation, but we also have a large group that does accounting courses, A&A style courses. So it can work for industry groups. We can work for various groups and organizations. Contact your state society. We can work through them to do that. So if you have something, you have a big enough group where it makes sense to bring somebody in, and you run the math here about how many it takes to make it work. But, if you have a big enough group to pay to bring someone in for a day, consider looking at that too. That's an option your state societies offer. They offer it for our courses. They offer it too, and normally for most everybody else's courses too. So you might think about looking at that. This has been the current federal tax developments for the week of April the 9th, 2018. We're going to have updates, probably not a whole lot this week because, hey, I'm heading to the 17th like everybody else. But we will, some things go up at currentfederaltaxdevelopments.com. Certainly after the 17th, they will. You can also send questions and comments to Ed Zollers at currentfederaltaxdevelopments.com. I post some links and some other information online at Twitter. You can follow me there at Ed Zollers. And I participate in the Reddit discussion group at reddit.com/r/taxpros. That's how you do Reddit groups. That's a subreddit. I participate there. You have some questions. You can post them there. There are various people that participate at that location. Well, I hope your tax season is going well, or at least as well as anything goes this time of year. And make sure, hopefully we'll all survive the next couple of weeks. And we'll then get started looking at what's going on as we get further developments in this next year that we know have a ton of developments coming. So be sure to catch us next week. Hopefully I get it recorded. No promises that close. It may come out after the 17th. Fair warning. So be aware of that. But hopefully I'll get something done. But we'll hopefully catch you here shortly. We'll talk to you about current developments, and we'll talk to you about what's going on here in the area of taxes. See you guys at the next broadcast.